today is Thursday, February 11th, and this is a post-market review and an analysis of the stock market activities today. The market continues to act boring. We're trading flat, low volume, with no noticeable activities. But we have two main themes that are consistent throughout the week. Number one, dip buying. Every time we see a mini sell-off from an intraday perspective, you see the dip buyers buying right away. And that is, of course, in part due to algorithmic trading. Furthermore, we see that the names that are outperforming happen to be involved in the options trading mania and the names that are being chased by the Reddit crowd. Absent of that, the market is absolutely boring. There's nothing going on whatsoever. We've already pumped the Qs, we pumped the IWM, we pumped the Dow Jones, and now of course we pumped chips, oil, banks, materials, everything was pumped. And the question is, what will take us higher? We need a catalyst to reignite the interest in the market and take us higher. The other theme we saw today is the outperformance of chips. There was a reason behind that. We know about the shortage in chips, but we heard news regarding the Biden's administration taking certain steps to alleviate the crisis. We'll talk about that and a lot more during the headlines of the day segment. But for now, we do have a market to cover, and here we go. The Dow Industrial Average closing in the red, down 7.10 points, or a decline of 0.2%. The Nasdaq closing in the green by 53.24 points, or a gain of 0.38%. The S&P 500 also in the green by 6.5 points, or a gain of 0.17%. And what about the sector's performance for the day? Leading the pack and capturing the gold medal, technology, thanks to the outperformance from the chips sector. At number 2, capturing the silver medal, real estate. And watch out for real estate because it has been the silent, quiet outperformer here. And I am starting to look at certain REITs to add to my portfolio. But here is the number 3, capturing the bronze medal, communication services. The laggards of the day led by energy, utilities, and materials. Moving on to the futures market performance for the day, starting with crude oil. We did not see any volatility in the US dollar today, closing pretty much flat. However, the rally in oil is taking a pause, and we saw declines for both the WTI and Brent to the tune of 1% or more. What about softs? We saw declines here led by coca, sugar, and OJ, while the gainers of the day led by lumber and cotton. Meanwhile, coffee futures muted for the session. What about metals? Muted activities across the board with exception of gold. Gold was down about 1% or so. And remember what I say all the time about gold. It is the mature guy in the room. Perhaps gold is predicting that we will see a resumption of the rally in the US dollar. What about meats? The piggies over lean hogs running hot once again. Massive gains for lean hogs, outperforming everything. While you're holding your diamond hands, the diamond oink is the hottest trade in town. We saw modest gains here for live cattle futures. Meanwhile, feeder cattle futures muted for the day. Moving on to grains, rebounding here with soybeans, soybean meal, corn futures all trading in the green. We saw gains in canola and oats future as well. Meanwhile, the laggard here are wheat futures. Moving on to the big casino, the options market, and let's see what's going on here. Leading the pack and the hottest trade in town for now, beside the piggies over lean hogs, of course, Sundial Growers. And this name has been rallying higher along with other weed names due to the pump from the Reddit crowd, and it's all done via call options buying. Now, we talked about this name, Sundial Growers, and I've been talking about it for a while now. The buying options for this particular name is absolutely dumb and makes no sense whatsoever. You're paying more for the options than the underlying price of the actual equity. What the hell is wrong with you? But I also told you that opens up an opportunity to exploit and take advantage of these donkeys. You buy Sundial Growers and you continue to sell upside calls. And this is what I have been doing for a while. And today I sold my shares in the pre-market session. I actually did not sell it. The broker did it for me. And if you think that I am some smart, sophisticated guy, that is all true and well. However, I am also susceptible of doing dumb mistakes. Because here's what happened. When I bought Sundial Growers, I set my sell order at the price of $4.20 as a joke. And I forgot about it. And in the morning, the pre-market session, I received a notification that my broker sold my Sundial Growers shares at the price of $4.20. Now, this is the smart part, of course, because the stock declined significantly today. So I managed to capture massive gains on this trade. However, here comes the dumb part. I also been selling upside calls, and I sold the $5 calls expiring tomorrow. When my broker sold my shares, they left me holding these calls naked, meaning that if Sundial Growers explodes tomorrow, by the tune of 100% or more, I will be in the doghouse because I'm gonna have to repurchase those shares once again and eat a loss if the stock explodes higher. If not, that will be a massive win. But the moral of the story is, when you see a trend like this, a cheap stock, massive options volume going on in the market, you take advantage from that, not by buying naked calls, but by buying the underlying equity and then selling upside calls. Just make sure that you close your calls before you exit the position. Don't do what I did. Anyways, Sundial Growers at number 1 with a little over 1.8 million contracts. But 71% of those were calls. And by the way, once again, they're trading more in notional value via options than there are actual shares available to be traded for the stock. But these are the same people who keep telling us that when shorts shorted GameStop over 120% of the available float, that was a dumb mistake, and they deserve to pay for it. Well, you're doing the same dumb mistake and then some. You're buying more in notional value via options than there are shares available for the stock. Moving on to Apple at number 2 with about 1.1 million contracts. About 74% of those are calls. And at number 3, Tilray. With almost 1 million contracts traded today, about 60% of those were calls. All in all, muted activities in the casino, very quiet with exception of the hot Reddit trades, which happen to be in cannabis stocks right now. Who knows where they will move next. Moving on to the interesting trades that took place in the options market today, starting with the KRE for regional banks. Of course, we saw a retreat in the 10-year Treasury yield yesterday. However, we saw gains today, and the outlook here is that regardless of Jerome Powell's attempts to play poker, the market is calling his bluff, and we'll continue to see yields rising higher. When yields rise higher, that is very good for what? Regional banks. You gotta be long regional banks. Pick your favorite and invest in that particular bank. Mine is US Bank Corp. If you don't want to pick, you go with the KRE. And in this case, we have a big trade in front of us for the KRE. They're buying the 64 calls, expiration date April 16th, with expectation that the name is going to rally over 6% by then. And they paid about $2.20 a piece to enter this trade, and that brings the total to over $6.5 million. Here's another one for the ticker WDC. This is for Western Digital. We saw enormous activities here for chip names, regardless of which one we're talking about, whether we're talking about equipment like Lam Research, AMAT, or whether we're talking about designers such as NVIDIA, Intel, etc., or even memory chips. And in this case, we're talking about Western Digital. Somebody bought the 70 calls, expiration date February 26, with expectation that the name is going to rally over 10% by then, and they paid about 80 cents a piece to enter this trade, and that brings the total all the way to about $1.7 million. And what about this trade for Uber buying the 65 calls, expiration date April 16th, with expectation that the name is going to rally over 7% by then, and they paid about $3.80 a piece to enter the trade, and that brought the total all the way to about $6 million. And here's one for the Qs, the Nasdaq, and in this case they bought the 358 calls, expiration date March 19th, with expectation that the Qs would rally over 7% by then. They paid about $1.25 a piece to enter the trade. That brings the total a little over $1 million. We're seeing consolidation all over the market in a bull flag formation, so somebody's betting that the breakout is imminent. What about the ticker PYPL? This is for PayPal. We saw significant surge of activities for PayPal today. In this case, they're buying the 310 calls, expiration date February 19th, with expectation that the name is going to rally over 9% by then, and they paid about 85 cents a piece to enter this trade. That brought the total all the way to about $500,000. And here is the last trade of the day for the ticker AMAT. AMAT, this is for Applied Materials, and we saw all of the semiconductor names rallying significantly higher upon the news that the Biden administration is about to shower some free taxpayer money to help all of these chip manufacturers and designers in the chip shortage crisis. In this case, they're buying the 120 calls, expiration date March 19th, with expectation that AMAT is going to rally over 6% by then, and they paid about $4 a piece to enter this trade. That brought the total all the way to $2.4 million. Moving on to the headlines that shaped the day, starting with macro news. And right away in the morning, we received the weekly unemployment claims. And here's what we got. The number of weekly claims for unemployment benefits decreased to 793,000 last week from 812,000 a week earlier. The Labor Department said on Thursday, claims have steadily declined since early January. It is a small improvement, and we know why. The reopening of the economy. Not all the way, but for example, here in California, we're back to normal. And when I say normal, I mean before the total shutdown, meaning that you have an outdoor seating arrangement for restaurants and bars, etc. And of course, that would help in rehiring waiters, cooks, bartenders, and that is helping just a little bit to improve the unemployment picture. Yet make no mistake that it has been almost a year since the crisis started here in this country, and we are still registering 793,000 unemployment claim every single week. And here is more, and perhaps more warning signals that even if we reopen the economy, the damage has been already done. U.S. employers have cut a net of 582,000 factory jobs compared with the pre-COVID level. Many of those won't come back, and indeed they won't. Permanent unemployment skyrocketing, and the reason is whatever factory jobs we had left here, they got caught, and the jobs are moving overseas. In addition, of course, to the commodities crisis, the prices are rising higher and higher by the day, and that is adding cost pressure on factories to the point where it's no longer worth it to stay open. And speaking of the commodities crisis, here it is. Oil and other commodities have probably entered a so-called super cycle, according to J.P. Morgan. We believe that the new commodity upswing, in particular oil upcycle, has started. J.P. Morgan analysts said in their note, the tide on yields and inflation is turning. Commodities have seen 4 super cycles over the past 100 years, with the last one peaking in 2008 after 12 years of expansion. While that one was driven by the economic rise of China, J.P. Morgan attributed the latest cycle to several drivers, including a post-pandemic recovery, ultra-loose monetary and fiscal policies, a weak U.S. dollar, stronger inflation, and more aggressive environmental policies around the world. Hedge funds, similarly, haven't been this bullish on commodities since the mid-2000s, when China was stockpiling everything from copper to cotton, while crop failures and export bans around the world boosted food prices, eventually toppling governments during the Arab Spring. The backdrop is now starting to look similar, with a broad gauge of commodity prices hitting its highest in 6 years. I hope that you're paying attention to what I just read. The rise in commodity prices has many ramifications, not just inflation and economic consequences, but also political ones. Corn and soybean prices have soared as China loads up on American crops. Copper hit an 8-year high amid growing optimism over broader economic recovery, and oil has staged a strong recovery from the depth of the COVID-19 pandemic as a worldwide supply glut eases. Meanwhile, the Federal Reserve told us yesterday there is no inflation. Inflation is just flat. Does anybody believe the validity of the core CPI inflation data we received yesterday? Then you must be a clown. And here is more evidence for you that the Fugazi number we received yesterday for the CPI core inflation means absolutely nothing. Here it is. Despite a weaker than expected CPI report today, 2-year TIPS inflation break-even rates hit a new 10-year high, meaning that the market is not playing poker with Jerome Powell. The market is reading through the manipulation, cooking the books, and playing poker. Here's more. The median price of a single-family home climbed 14.9% in the fourth quarter, the biggest surge in data going back to 1990. The National Association of Realtors said. Oh, but where is inflation? I can't see it. Where are my glasses? Here is more. While the 10-year Treasury yield is still at low levels historically speaking, the regression model for equity stocks and commodities has already exceeded 2%. And we know from historical correlation that these two trade hand in hand, and the divergence is not going to last for too long. What does that mean? It means that the 10-year Treasury yield will explode higher. The velocity of the move is going to shock everybody. To catch up to what? The regression model, which is reading right now at over 2%. So we could go from the levels we're trading at right now to 2% in an instant, and that will 100%, I repeat, 100% cause a market crash. Oh, and what about the stimulus? Do we have any more news regarding the stimulus? We have surveys about how the new stimulus round will be spent by consumers. Here it is. Percentage point change in how respondents reported spending their first stimulus check to how they intend to spend their third check. We're talking about the $1,400. 11% savings, 2% vacation or trip, 2% investment in the stock market, surprise, surprise, 1% in housing, no change in home improvement, no change in credit card debt, and negative 2% change in food, a negative 3% change in clothes. So the majority will go into savings, but we will see a significant amount also going into the stock market. And we know that 28% of all Americans bought meme stocks last month. Here is more. Share of respondents who report saving or intending to save. We're talking about the third stimulus check. A noticeable increase in people who earn less than 50 grand, a modest increase for people who are earning 50 to 100K. And here is a bit surprising. For people who are earning more than 100K, the jump is also extremely noticeable. More of them are saying now that they will save the third stimulus check. Of course, they're all waiting to buy the dip in the stock market. But isn't it ridiculous that we will give stimulus checks to people earning more than 100 grand? But anyways, the helicopter money is being dropped all over the place, so you might as well take advantage of that. Who cares? Let's rack it up for the next generation. Let them deal with it. And let's talk about the whole chip crisis. We have a chip shortage, and that will impact a lot of industry, from automotive, industrial manufacturing, electronics, etc. And now, of course, it's becoming quite a national security issue, because we know that our military also depends on the supply of chips. And the US chip industry is meeting with the Biden administration and calling on the Biden administration to fund factories. There is a chip shortage. All of the resources are overseas. They ship the jobs over at Taiwan, China, etc. and they betrayed the American worker. And now all of a sudden, they realize the importance of having factories here, but they don't want to pay for it out of pocket, even though it will benefit them the most. They want some of that helicopter money. They want some of that taxpayer stimulus money. They want to be included in the stimulus bill and have the taxpayer build the factories for them.
Press Secretary Jen Psaki just concluding a briefing where she made some comments about the global semiconductor supply shortage, saying that the administration is currently looking at ways to immediately alleviate and identify any potential choke points in the supply chain, but that the chip industry will figure prominently in a forthcoming executive order where the White House will be initiating a comprehensive review of critical goods that are manufactured here in the U.S. and setting potential incentives for onshoring that manufacturing. When she was asked specifically about a request by the Semiconductor Industry Association to include funding for research and development and manufacturing in the president's upcoming Build Back Better infrastructure plan, she said those discussions are ongoing and there is not yet a price tag for that package or a decision on whether it will be included. Andrew?
And here is what I said. Corporate America asking for more corporate welfare. Yet keep defending corporate America and big businesses, because God forbid these poor people get hurt if we raise the minimum wage slightly. God forbid. They might pay a little more. Meanwhile, me and you, the taxpayer, are flipping the bill to subsidize their underpaid workers, their tax cuts, their business expansion projects, building factories for them, bailing them out when they're in trouble, showering them with trillions and trillions of dollars because they're too big to fail. Here it is. Sources of federal revenue as a share of GDP. Corporate income taxes contribute less than 2% of the entire revenue of the government. Meanwhile, we, the individual income taxpayer, get to pay the most. Corporate America don't pay their employees a living wage. They have to rely on government welfare. Who do you think pays for government welfare? Me and you. When oil companies receive government subsidies, who do you think pay for those subsidies? When Amazon make tens of billions of dollars worth of profits, yet they pay 1.9% in effective tax rate, who do you think make up the difference? Me and you, the individual taxpayer. We are the one getting robbed here. It is just amazing to me how the citizen rushes to be a pro bono defense lawyer for big corporations when they are robbing the citizen. It's just a clear illustration of our poor education system and the propaganda that has been going on in the media for years and years. And here it is. Amazon paid $162 million in taxes on a $13.9 billion in income in 2019. That is a 1.9% tax rate. Not hard to see how Mr. Bezos is so successful. He is being subsidized by the rest of us. By the way, Amazon did not pay any taxes for the 2 prior years. Welfare state. You complain about the welfare for the poor and hungry, but you don't complain about the welfare for big corporations and the richest people in the world. What a beautiful way of thinking. And now we have the chip industry asking for more taxpayer money, free money, so they can build factories here in America after they screwed us and they shipped the jobs overseas. Now we have to pay them back. They shit in our heads and we have to say thank you for the hat. Wake up, people. Wake up. Moving on to sentiment news, starting with the crypto mania. And now it is becoming a global phenomenon. Here it is. Retail investors' excessive speculation in cryptocurrencies may fuel instability in Thailand's capital markets, according to the country's finance minister. And here is Lindsay Lohan pumping Bitcoin, saying Bitcoin to the moon. And of course, if you want to do it with Lindsay Lohan, and I'm talking about taking Bitcoin to the moon, of course, make sure that you use some form of protection. And as Dr. Fauci says about masks, double up because you're going to need it. But not every news about the Bitcoin mania is necessarily bad. Here is from MasterCard. MasterCard will allow merchants to accept select cryptocurrencies on its network later this year. And of course, we heard from the Bank of New York Mellon accepting cryptocurrencies now. And of course, this is way bigger from a news perspective and an importance perspective than Tesla buying Bitcoin. When the Bank of New York Mellon decides to accept Bitcoin, you have entered a new level of acceptance and legitimacy. Because if you worked in capital investment before, you know that when you dedicate your clients' accounts to passive investing, usually go with Vanguard or BlackRock. They tend to like BlackRock these days. But once in a while, you get a client who will say, I want the VIP treatment. My account is at 50 million, 100 million, 200 million, and I want the VIP treatment. I don't want to be in a pool with a bunch of other people. You take their account and you send it to the Bank of New York Mellon, and they get that white glove treatment. So the fact that they are accepting Bitcoin is a very, very big deal. Continuing with market sentiment, what about the ARK mania from Tesla witch Cathie Woods? How is it going? It's getting hotter and hotter by the day. Here it is. Cathie Woods' 6.8 million bet on Ping and Healthcare, which is a dumb name by the way, unleashed a flood of buy orders from copycat investors, lifting the company's market value by 3.3 billion. And of course, this is a clear illustration of how the new zombie generation of investors, the SPAC generation, invests. Cathie Woods buys first, she shares the spreadsheet after she buys, and then they go stampede, Naruto style, heads first, ask questions later. Matter of fact, don't ask questions, just put your blindfold on and buy. They don't even know what the company is. They've just been fed a ticker that is good for the zombies to make an investment decision. And it shows you that the market dynamics are led by a few cult leaders. Elon Musk, Chamath, Tesla witch Cathie Woods, and a few others. They spit out tickers to the zombies, and the zombies do their job and they buy these stocks. Fundamentals, valuations, profits, even revenues, who cares? Who cares if the company even exists or not? If Cathie Woods feeds us the ticker, we're buying. And here it is, the S&P 500 index versus non-profitable tech. Non-profitable tech, since the zombie investors joined the market in the March 2020 bottom, they have shot non-profitable tech, I repeat, non-profitable tech, to gain over 250% over the S&P 500. And they keep telling us that this is the smartest generation. They can do research and amazing work, yet they're investing in non-profitable tech. They're investing based on stories, hopes, dreams, and we know how dreams end. You end up waking up and the dream goes away. Very few winners from this segment, non-profitable tech, will emerge. Very few companies. Remember back in the 1999 dot-com bubble, there are names that you don't even remember, but they were the hottest names back then, and they all disappeared. Which company or companies emerged victorious after the fact, and they indeed became the future bro? I'll give you an example. Amazon. Amazon participated in the mania in 99, but if you bought Amazon back then, you were made fun of. People laughed at you. Really, Amazon? Bro, the company that sends you books over the mail? Who needs that when you can go to the bookstore and buy the book? We know how that story evolved. Meanwhile, the other companies the bros were buying, they don't exist anymore. On what about the margin debt mania still going on? Hotter than ever. Margin debt as a percentage of the Wilshire 5000 market cap has steadily declined since the global financial crisis. Yet as a percentage of the GDP, it has soared to record highs. Why is that? The answer is, I'll take zombies for 500 Alex, the zombie generation of investors. They borrow money from Robinhood or whatever, and they go all in. Naruto style, buying the riskiest assets of them all. Companies with no profits, stories and dreams on borrowed money. Again, you can disagree with me and you can say, hey, the bull market is going to continue for years and years and I am bullish, etc., etc. But you cannot ignore the facts. Look at me with a straight face and tell me that this is not problematic. They're gambling with borrowed money. It's a ticking bomb. What about the small caps mania? Now the analysts joined the shit show, and here it is. US small caps have seen rapid revisions in EPS forecasts, beating larger rivals. The analysts have lost their minds, of course, and now they're revising earnings for small caps, the IWM, higher and higher and higher, not only exceeding the S&P 500, but also exceeding the NASDAQ. Are we in an extreme mania or what? Speaking of extreme mania, how is the penny stock and options gambling manias going? Pretty good. Hotter and hotter by the day. Penny stock volume reaching all-time highs. Options volume all-time highs. Meanwhile, the actual SPY volume, meaning that the volume for the stock market, is at all-time highs. What does that mean? The market is moving higher via call options gambling and penny stock gambling. Oh, and did you catch this clown yesterday on CNBC? He said something that could rival Buy Bear Stearns from the famous Jim Cramer. And of course, we know that a few days after that recommendation, Bear Stearns collapsed. But this one could rival that call.
Valuations don't tell you anything about what stocks are going to do in the next 3, 6, 9, 12 months, or even 5 years. In fact, one of the best investment strategies looking in the rearview mirror that you could have employed over the last 5 years was to own the most expensive stocks in the market. So I could look at a PE ratio and tell you it makes me feel good or bad or a little doubtful or a little nervous, but honestly, it's junk science at best. There is nothing there. There's no signal.
And of course, while Josh Brown says that valuations don't matter, don't forget that this guy's a snake, a weasel of the highest degree, because he likes to gamble on speculative names. And when the February crash of last year took place, he lost a ton of money. So what did he do? He applied for a PPP loan, which was intended for small businesses, but because he has a hedge fund with 5 employees, he qualified for a PPP loan. He took the money, he bought the bottom, made a ton of money on taxpayer money that was intended for small businesses, and the lifeline worked. He's back in the green again. He takes the money, he pays back the taxpayer, and when he is criticized, he says, "Oh, but I paid it back. I paid the loan back." Of course you paid it back because you cheated. You took the taxpayer money, you bought at the bottom, and you rode the ride higher when you were supposed to eat losses. You got rescued and bailed out by the taxpayer, you snake. And now he's giving us advice and telling us the valuations don't matter. Make sure you save that clip and rub it all over his face when the crash happens. Back in sentiment news, what about the IPO mania? What's going on here? Any updates? I got some for you. Playboy, called PLBY Group, now resembles a global consumer products startup with brand name recognition, and they are set to go public. Playboy, we're not talking in the 70s or the 80s or even the 90s. They're going public right now. Why not? The zombies have their wallets wide open. Wide open. You just have to sell them a story and you'll take their dumb cash. And here is the clearest illustration of that phenomenon. Bumble, this is a dating app by the way, climbed more than 85% in its trading debut after its initial public offering was expanded to raise $2.15 billion. Do you even know if this company even generates profits or not, or if it even generates revenue or not? What is the moat for the business? Absolutely none. They claim that their moat is that women message first. Oh really? Nobody can copycat that at all. There's a dating app popping up every single day. Where is the moat? And here it is. Bumble founder Whitney Wolf Hertz. That's a perfect name, by the way. She's a wolf eating the herd. Fortune rockets past 1 billion as the dating app goes public, making her the world's youngest self-made woman billionaire. Good for you, Whitney. Excellent timing. You just gotta cross your fingers and pray that the mania is gonna continue until you're allowed to dump your shares. And speaking of dumpers, here is the new segment for this show. Starting with Tesla and specifically the Musk family. And we know that the Rev has a younger brother. His name is Kimball, and he happens to be the Fredo of the family. It must be beautiful having an older brother who works hard and you get to parasite on his hard work. And today, according to an SEC filing, we received the news that Fredo Musk has dumped over $25 million worth of Tesla shares. Let's check on other dumpers and see what's going on here. Here is for Penn National, Peter Carlino. This is the chairman emeritus, selling over 371 million shares, while the zombies are chasing the name higher and higher. What about Roku? Here's Anthony Wood, the CEO, dumping over 131 million worth of shares. What about Tesla? Here is the director Antonio Gracias, also dumping over $120 million worth of shares. What about Peloton, the ticker PTON? Here is Bill Lynch, who happens to be the president of Peloton, dumping over $72 million worth of Peloton shares. What about Nelson Peltz, dumping over $50 million worth of Procter & Gamble shares? And here it is, Bob Iger of Disney, dumping about $100 million worth of shares. What about Palantir? Here is Alexander Karp. He happens to be the CEO of the founder. He's dumping about $40 million worth of shares. Even BlackRock CEO Larry Fink dumping about $20 million worth of shares. Meanwhile, me and you, the dummy retail trader and investor, we continue to go heads first, Naruto style, and buy, while these people dump on our little heads. Moving on to corporate specific news, starting with Tesla. Elon Musk's promised 25,000 Tesla EV will be sold globally. Of course, this is an attempt to enter the Indian market and other markets in Asia where the Model 3 is just too expensive. And rumor has it that this new $25,000 Tesla EV will only exist digitally. Of course, the zombies will stampede to buy it anyways. Continuing with corporate specific news. Here is General Motors investing $100 million in 2 U.S. plants to boost transmission production. And here is more in the automotive world from VW. VW partners with Microsoft on automated cars. The competition is heating up. It's the hottest sector in the 2020s. And lastly, let's finish with this. Hormel Foods will buy the Planters snack brand from Kraft Heinz for $3.35 billion in cash. Do you like cheese balls? Don't answer that question. Moving on to the heat map analysis. Let's see what's going on here. Muted activities throughout the board, tilted red. However, you see the pockets of outperformance very clearly. Happening from where? The chips names, Taiwan over 4% gains for the day, Nvidia over 3%. Of course, I bought the stock and I continue to sell upside call options. Intel over 3%. Even the memory names participated. Micron over 5% gains. Marvell 3%, Texas Instrument over 2.5%. But the majority of the gains took place in the semiconductors manufacturers, because the whole point is that the Biden administration will include building new factories for chip production in the new stimulus bill. We're talking about chip production in the United States. We know that Taiwan Semi building a factory in Arizona. This is how it's supposed to be. Corporations investing in their own businesses. It shouldn't be corporate welfare where the taxpayer flips the bill for an investment that benefit public corporations. But we also saw the Bitcoin names participating to the upside. We're talking about Square closing above 3%. MasterCard, after announcing that they will accept cryptos, specifically Bitcoin, with gains over 2.5%. Visa participated based on that news. Bank of New York Mellon up almost 1% today. Any name that is getting involved with Bitcoin is catching a bid. The problem is if Bitcoin slides lower, all these names will get hurt hand in hand. We also saw gains in some of the main trades, the momentum trades, specifically for Airbnb. I've been showing you lots of options trades, pretty much every single video this week for Airbnb, and most of them happen to be calls. And we're talking big bucks, millions and millions of dollars. And you're seeing Airbnb moving higher today to the tune of almost 2.5%. We also saw significant gains for Pinterest. over 7% on rumors that Microsoft was planning to buy Pinterest. Another winner of the day, Zillow. Zillow closing almost 18% gains for today after reporting earnings after the bill yesterday. What about consumer defensives? Coca-Cola gaining about 1.5% today alone, and I did add to my position. I already own Coca-Cola, but I added to my position after they reported earnings yesterday. I think the worst is behind for this name. The only problem you have to watch out for is this dispute between Coca-Cola and the IRS. It could cost them over $12 billion. What else going on in consumer defensives? Take a look at Kraft Heinz. We just talked about cheese balls, and you see Kraft Heinz up almost 5% today. Tyson, different story, down over 5.5% after reporting their own earnings. We saw declines in utilities, real estate, materials, energy. Exxon down over 2.5% today. Mixed activities in industrials, Triple M down over 2%, UPS down 2%. Meanwhile, the notable gainers here, railroads, specifically Union Pacific, up over 1.5%. Some interesting action in healthcare, but the big drug manufacturers remain muted, although we have news after the bill that the government is buying more vaccines from Pfizer and Moderna. So watch out for these names. They could move big tomorrow. Moving on. The charts analysis, starting with the SPY 15 minutes chart. We're just consolidating here in this wedgish formation, and we're about to break out of the consolidation in a large move, up or down. This is the calm before the storm, and the storm could happen to the upside or the downside. For now, the odds favor the upside. Why do I say that? Number one, we saw consistent dip buying throughout the week, meaning that the appetite to buy the dip is still intact. Number two, the technicals are still very bullish. We have bull flag formations across the market. If that is negated and we see bearish formation, then the argument will change. On the other hand, the bearish side, there were signals that we are starting to crack. You saw those big flush downs from an intraday perspective happening 3 days in a row now. Midday, you see that big flush down around 8 to 9 a.m. Pacific time, and then you see the dip buyers showing up and buying the market higher. So once again, it's a battle. Bulls versus the bears. It's the calm before the storm. Of course, the news regarding the stimulus could tip the scales one way or the other. What about the daily chart of the SPY's continuous contract? Once again, trading almost all-time highs, above the support lines, consolidating in a bull flag formation. And the question is the next big move taking place to the upside? It certainly appears so for now, but you have to remember, we're seeing a negative divergence in the RSI, signaling a loss of momentum. And if you look under the hood from a 15 minutes perspective, you can't help but to notice those big flush downs that we experienced the last few days and the gaps we left open. You can't make any decision right now. For now, it is the calm before the storm, and you don't know which way the breakout is going to happen. But as the break is taking place, you will know right away and place your bets accordingly. For example, take a look at the SPY's continuous contract, the futures, the E-mini. How do you know it is a break to the upside? Very simple. Look at the RSI, breaking higher, breaking that negative divergence is very important. And of course, it is no-brainer. If you see us trading at all-time highs, then the trend is going a lot higher. Breaking the level of support of 38.62, on the other hand, will be your signal that the break is going to happen to the downside. Moving on to the Qs, what do we see here? Another gap higher, and then we see that massive flush down around 9 a.m. Pacific, and then you see the dip buyers buying the Qs from where? From the support of the trend line, and you saw the Qs closing positively. All in all, inconclusive. There's nothing you can do right now. The trend remains bullish. The path of least resistance remains to the upside until you start to see technical damage on the charts. And for that, let's zoom out and take a look at the continuous contract for the Nasdaq. Similar story with the SPY. Bull flag formation, consolidation, and the break is likely to happen to the upside. However, we are still technically in a negative divergence in the RSI, signaling a loss of strength and momentum. And if we break below the support level of 13,599, that would be your signal that the break is going to happen to the downside, not the upside. And by the way, I'm not talking about a break below the support line from a 1 minute perspective or 1 second perspective. If you're sitting in front of the screen with a big jar of Vaseline and you're watching the market tick by tick, be careful here. I'm talking about the chart closing on daily basis below 13,599. Now you're going to spot it ahead of time if you are an experienced trader. You will spot it from the 45 minutes chart or the 1 hour chart. You will know right away which direction we're breaking into if you are an experienced trader. But if you're not, wait for the daily confirmation. Moving on to the IWM. What do we see here? A bear flag that played to the downside. Now we have another bear flag. We're still trading at all-time highs. Almost. We have the support of the trend line. For now, the bullish trend remains intact, even though we're seeing clear signs of exhaustion and overextension. Let's zoom out and check out on the RUT, the Russell 2000 index, and see what's going on here. Very massive, very steep trend that the Russell has been climbing. At some point, gravity will take place. It cannot just keep climbing over and over and over a very steep line. For now, we're consolidating in a bull flag formation. We have a slight divergence, negative divergence in the RSI. And by the way, I'm not trying to confuse you here, but here's another thing you have to watch out for. Let's say that the bull flag formation takes place and we see a breakout higher in the RUT tomorrow, for example, and you see that massive gap higher. Watch out for what I talked about a couple of days ago, the intra-day reversal. What does that mean? It means that the bull flag plays out, we gap higher, and then we crap and we reverse. That would be a very strong, and I'll repeat, very strong reversal signal. That is what I'm watching for tomorrow and all the way to next week. What about the Dixie, the dollar index? Any update here? Not at all. We are still in a series of higher lows and higher highs. Until you negate that series and you make a lower low, the trend remains bullish. Moving on to gold. What do we see here? Gold had a bad day, even though the dollar did not do anything at all. So is gold predicting an upward move in the US dollar? It certainly did that before. Gold likes to predict things before they happen, and gold does that very, very accurately. I'm not buying gold until we break the resistance of 1870. Absent of that, I have absolutely no interest. What about the 10-year Treasury yield, the TNX? We completed the ABC pattern, and now we're consolidating in which formation? A bull flag formation, suggesting that we are going to continue to break to the upside. And by the way, I keep getting a lot of questions regarding the TLT. If you are buying the TLT for the long term, you are suicidal because you're not following what's going on with the macro outlook. You can trade the TLT higher, but be careful of holding it long term because the trajectory for yields are higher. The trajectory for bond prices lower. So we're waiting for the TNX here to take another leg higher. That could happen, by the way, hand in hand with a break higher in the indices. We're talking about the NASDAQ, S&P, Dow Jones, etc. Moving on to the VIX, the opposite picture of the SPY, consolidating in a bear flag formation. But watch out here. Don't make any definitive assumptions. Don't commit a large amount of money making a bet that what you're seeing on the screen right now will play as it should. The SPY going higher, the VIX going lower. This could be indeed a bull trap in equities. Having that formation, fooling everybody that it is a bull flag that is about to break higher, but doing the technicals alone is not enough. Read the psychology. The psychology says that dip buying is still alive, but we're kind of running out of steam here. Who is going to buy the market at these prices absent of a new catalyst? We're seeing signs of exhaustion. They've already pumped every single sector of the market. So you have to combine the psychology with the technical analysis. And for now, we have an inconclusive take. We have to wait for a confirmation tomorrow. What about Apple? Pay attention here. This is the leading indicator. Watch out Apple very, very carefully. Absent of closing above 138, the bear flag remains in play. Closing above 138 means that we're continuing in the bullish trend of the higher lows. But the canary in the coal mine here is Apple. Not chips, not the software names, not Microsoft, not Tesla, not anything. Apple is the canary in the coal mine. Moving on to Tesla. What's going on here? We saw a little bit of weakness yesterday. Today we went up, we went down, pretty much closing flat, yet managing to close about 1% in the green. The volume is dying here for Tesla. And we're seeing the bears being more emboldened. They're buying puts, they're announcing it publicly. Some are shorting Tesla altogether. So the bears are smelling blood here. The bears are looking at a wounded animal, a wounded prey, and they're stalking and stalking and stalking, waiting for that perfect moment to short this name. Once again, it could be a bear trap, but we know that Tesla has been moving solely via call options buying. We're not seeing that happens anymore. The retail trader is busy with the new weed names, or whatever new trend is going to be, and a lot of them are stuck with GameStop, AMC, and the likes. So absent of the new stimulus, how are you going to buy Tesla? It is very expensive to buy the stock, and it is very expensive to buy the calls. You can make a lot more gains trading sundial growers, for example, a lot cheaper than Tesla. It makes Tesla looking not sexy at all like it used to before. At least this is for now. But we know that Elon can manipulate the market all he wants. There are so many factors that could come in play here. But from a technical analysis perspective alone, Tesla is starting to look very, very weak. And now, moving on to conclude this video. We have different themes in the market that we discussed before. We have the nostalgia stocks, aka the reopening stocks. And then we have the weak dollar names. We discussed those in details. And then we have the high inflation names. We discussed those also in details before. And don't forget, we have the Biden names. And you see a lot of overlapping here. These are the names that will benefit in the long term, according to the macroeconomic trends. However, we did not see any of these themes coming into play this week. Matter of fact, this week had no theme whatsoever. It's all over the place. It's the calm before the storm, or what I call the headless chicken market. The headless chicken market could drop dead at any moment. However, you could electrify it, shock it to keep it running around and around for longer than you expect. What are we talking about here? The new stimulus bill. It's all about the details. A bigger than expected stimulus and paying people $1,400 will be very positive for the market. It could push inflation higher at some point, and that will have unintended consequences. But on the face of it, at least in the anticipation period, the market will go higher if we have a confirmation that we will receive another round of stimulus. Anticipating what? A lot of that money will find its way in the casino. And the headless chicken will have another round to keep running and running. More restrictions, less than expected stimulus will once and for all let that headless chicken drop dead. So all eyes are for now fixed on the details of the upcoming stimulus bill. With that being said, that's all I got for you today, and I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.